Is your Roth IRA a tax strategy or a tax trap? Well, here to talk with us about that is Robert Braglia from American Financial and Tax Strategies. Robert, welcome.
Hi there. Hi there.
So, you recently wrote an article about this very topic for Retirement Daily, and we're eager to have you walk us through what you wrote.
Sure. The essential premise is everyone seems to focus on Roth IRAs as being just this fantastic, complete upside, no downside. And what I did in the article is examine that in many, if not most cases, it really isn't. It's what I call a tax trap. And a tax trap in the manner that when you boil it down, it's a way of Congress getting you to pay your taxes years or decades before they're actually due. And I think very few people look at it that way. So what happens is then we've got these calculators. There are calculators you could come to online and says, well, the taxes would be this in the future and you'll save this, you'll pay it now, but it will be tax-free later on. But they ignore a couple of basic issues to me. The calculators make a lot of assumptions, or we have to plug those assumptions in. A big one is tax bracket. So what tax bracket are you going to be in 20 years or 30 years? Well, who the heck knows? I kid and say, I don't know what tax bracket I'm going to be in next year at this point. So that's a critical issue. The other critical issue is everything assumes the law is going to stay just as it is now. Tax rates may fluctuate a bit, but everything else will stay the same. And I don't have a high confidence in that. The example that I use is Social Security. When Social Security was passed, it was very clear in the law that these benefits will never be taxed. Several decades ago now, but years after it was passed, Congress needed money. They said, this is an easy place, and it's now taxed at 50 or 85% of the amount, at ordinary income tax rates. Well, if that goes to 100, that's going to change the calculation completely and make the conversion a little less attractive. And I kid in the article and say, and I can't imagine Congress ever looking for more revenue. The other element, of course, is what is typically said is, well, if you've got some money sitting around, convert the Roth IRA, pay the taxes with this money sitting around, and it's just a win-win. The part of the equation that never seems to be done is, well, why is there money just sitting around? If it's a cash reserve, okay, then it needs to be a cash reserve. But if it isn't, then that money should be invested, and that should be part of the equation. So my thinking is that there are just too many unpredictable factors to really to sort of slam dunk, knee jerk, say yes, Roth conversion. There's been a lot of marketing. I think a lot of the impetus for the marketing is bring your money to us. Here's a reason for you to change advisors, change custodians, or whatever. So I'm not sure that those are always the best intentions. Now, there are a number of cases where it is a good idea, and I call that, in my lingo, the free Roth conversion. So I had two of them at the end of last year, people that were in very low brackets for one reason or another. And I work with the accountant. I say, well, how much income could they take? And it's always an estimate, of course, and be in a zero or very low, just the first tax bracket. One client, an old friend, is a man who finally sold his father's business that he was in his whole life to pursue his career as a photographer. He's an incredibly talented photographer. Well, he's a little income light for a couple of years as he establishes himself. So I said, hey, here's a great opportunity. Worked with his accountant. We came up with a number. We converted a chunk. And that's happened a couple of times over the years. So I'm not absolutely against Roth conversions, but I'm saying take a real look. And if you're really just swapping taxes now for taxes later, the money that you're spending in taxes now probably can be put to better use.
Right. So obviously, in the article, you've challenged conventional wisdom and thrown it on its head. One of the arguments that people make for having a Roth is that though you may not know what taxes will be later on, the likelihood that they'll be lower later on is unlikely. And so that means that whatever money you have in a traditional IRA is likely to be the income, the distributions will be taxed as ordinary income and likely be taxed at higher ordinary income tax rates than they are now. Any thoughts about that as one argument for at least having maybe a mix of assets or a mix of accounts, some in your IRA traditional and some in your Roth?
Yeah, it's a valid point in the sense one could look at it as paying taxes at a discount, paying it early, but at a discount, because of course, what remains after taxes will grow tax-free and never be taxed on the other end. I'm just saying we just have to add back into the equation the money that you pay in taxes. In the future, tax rates may be higher. But if the tax rates are higher, that means, again, back to my original premise, that they're looking for revenue wherever they can. And I think there's a real possibility, maybe not in the next few years, but many years down the road, that they say, hey, look, this money's never been taxed. We need to tax at least the appreciation from some point in time. And they always say, but only on the wealthiest Americans.
Right.
And whenever a tax law refers to the wealthiest Americans, I always ask them to set that point at $1 more than I make. But they never seem to do that. And it ends up hitting a lot more people than people who consider themselves wealthy. I live in New York City, so it costs a lot to live here. And people that make a very nice income really are not wealthy.
So in the minute or so we have left, just a quick follow up. Obviously, it's not easy to look at whether to do a Roth or a Roth IRA conversion based on one factor alone. But one factor that came last year because of the CARES Act, forgive me, it might have been the Security Act. Losing track of all the legislation, where we've lost the ability to do a stretch IRA, and obviously with Roth IRAs, there is no need to take an RMD, though there is a need for your heirs, your beneficiaries, to take distributions. Any thoughts about whether that makes it one more reason to do a Roth IRA?
Yeah, it's a factor, Bob. I think my point is simply that greater thought, greater analysis needs to go into the decision. And when you do that, many times you're going to find it isn't a good point. It's a factor, but don't forget spouses, with the exception of the 10-year rule and all, we could be talking about paying taxes 30, 40, 50 years before they're due. That's too many unknowables for me. Take the deduction now, or don't, or keep, if it's a contributory Roth, make it a regular IRA, take the tax deduction, or do something with the money that you would otherwise pay in taxes. In most cases, there are exceptions, and my premise is simply go to the next level of analysis. Don't just say, hey, this is cool, I'll never pay taxes again on the money. Really, really take a hard look at the numbers.
All right. Well, Robert, I want to thank you for sharing your knowledge and wisdom about this topic with our readers and our viewers. It's greatly appreciated.
Okay, thank you.